네, 월가 트레이더 버니의 미국 주식 시간으로 돌아왔습니다. 앞서서 이 암호화폐와 관련된 글로벌 이슈까지 체크를 해봤는데요. 이 이야기를 하는 이유는 아무래도 우리나라에서도 이 글로벌 시장에 뛰어들면서 서학개미로 불리면서 테슬라 등 올라가는 이런 성장주들에 투자한 개인 투자자분들도 많으실 거라 생각이 듭니다. 이러한 종목에 대해서 적절한 투자 타이밍을 고르는 일이 굉장히 중요할 텐데 그 부분에 대해서 오늘 버니 씨가 이야기를 해주신다고 하니까요. 여러분들 귀를 쫑긋 세우시고 들어주시면 좋을 것 같습니다. 오늘 준비해 주신 내용 지금 바로 만나보시죠.
To think about how the average stock has done this year, let's put this whole stock market into perspective. Let's think about the fact that we had a bull market that started on COVID, and we've gone forward from there. So what we can look at, this chart really is the strongest bull markets and how long they've lasted in years, okay, from World War II on. So what we can see is this is our current bull market right now. We're only about 2 years into it, March of 20 to current, okay. What we did is we had the fastest start to any bull market up till now. We're now in, let's call it in second place, right? Right behind the March 09 to February of 20 before COVID hit, okay? So what we're now doing is we're starting to leak back into there. But if you think about how long bull markets go, they go 4.5 to 10 years. So we've got more to go. But what we have is that we know that even in a positive market, we can still have corrections. So the fact that we've had a correction so far is not out of expectations. Now, when we look at technology stocks, okay, this just looks at technology stocks, and what we're trying to do here is to identify how well technology stocks have performed. And you can see that there's been a significant amount of selling pressure. These are stocks that are above their 50-day moving average. And you can see 200-day moving average, I'm sorry, above their 200-day moving average. And you can see how low we've gotten. Now, I'm not saying we can't go lower, but when we get down here, typically we've had opportunities to buy versus opportunities to continue to sell. When we take it and look at some of these stocks in and of themselves, look at what's happened to Microsoft. Just a classic right here. We had a significant sell-off from December into the March lows, okay, lower than where we got to in late January. Then we had a good bounce, but we're not breaking down. We're not going lower. What would be great is if we can get back above this gap that we had after the initial rate hike, and now we've gotten this move. This is through Thursday of this week. So what we'd like to see is a market that starts to get back above 290-300. That's not asking a lot for a stock that's at 275, that back here was significantly higher at around $350. Now, let's put this correction again. So we're looking at stocks and how well they perform. Let's think about this correction. Let's look at, so you can see how many years we're up and how many years we're down. 2008, 2001, and 2000 down there. And then these diamonds are how deep we pulled back off of the highs. The gold line, horizontal line, is the average setback that we've had. So right now, this is at 13%. We're down to about 14%, so we're a little bit lower than here. But if we look back at this chart, somewhere between 14 and 19%. Other than that, we've gone down. It's been a much deeper liquidity drive down. I don't necessarily know if we're going to go much lower than that. So when we think about all of these together, we keep thinking about how deep we are on average. Then we want to think about the number of stocks that are below their 200-day moving average. We want to think about how pervasive negative sentiment is. And finally, we want to think about the lack of liquidity, because bottoms are set where there's low liquidity. Now, don't forget this is in a midterm election year, and you can see that the average decline, pullbacks off of the highs in every year, we're about the deepest we are in a midterm election year. And then these gray bars are how far we've rallied on average off of those lows within the next year, so 12 months later. So we're 14%, we're not quite down as far as we could go, maybe a couple more percent, just thinking only about a midterm election year and what goes on from there. Now, when we think about midterm election years, let's just go back and go through this. We've done this before, and this is a table that I've shown before, and I ran this through March 8th when we were only down 13% in the S&P 500. We're now down over 14%. But you can see that the average return, 17.1, just like we looked at it before, okay? And then you can see the distribution of returns off of the lows that we hit this year, how good those returns are. On average, they're around 32%. So if we can identify a bottom this year, just thinking about the midterm election year and then taking it forward, we should anticipate that there's going to be some good buying opportunities. When we think about Microsoft, we can think about that. When we think about how deep some of those technology stocks are, we can think about the fact that Shopify, which was a great stock, had a great 10-year record, was over $1,500 in the second half of last year. It is now down to around $370. That's a fairly significant sell-off. This is of a stock that's still anticipating 28% revenue growth for the next year going forward. So these stocks have been beaten up. These stocks are getting cheap. We're not trying to necessarily pick a bottom, but we're identifying conditions where the stock sell-off has been so significant that there is a place now for the market to start to work a little bit higher. Finally, what we think about is we go back to look at the number of stocks above their 200-day moving average. Let's just think about the Nasdaq, not technology stocks, but the Nasdaq, which has most of the technology. This chart right here is the Nasdaq Index, and we can see how strong that rally was off of the March 20 lows that we had with COVID. And what we've got on the bottom are the number of stocks, the percentage of stocks that are above their 200-day moving average. And the red line is right at 30%. So before we looked at it on technology stocks, it's 17%. On the Nasdaq as a whole, it's 30%. When we've gotten down here, these blue arrows show when we've gotten there, we've always had, over the last 12 years, good buying opportunities. So once again, we think about the fact that are stocks cheap enough right now or not. Now the difference is every one of these occurrences before we've hit this 40-week exponential moving average. Whether we hit it or not, I don't know. The difference is that we had such a substantial move away from that moving average that maybe we just give this moving average a chance to catch up to the market. But we've started to see bounces in this average where these number of stocks below their 200-day moving average is starting to improve, which means some of the stocks are not now below their 200-day moving average. First indication of some type of a positive sign. We can still roll down here, but I think over the next few weeks, this market should start to base and we can try and see if we can do better. Looking for new information to get us more positive overall so we can experience that second half of the year midterm rally that we've had on all these other occasions before.